Welcome to This Explainer. Today, we are diving into exactly why your health insurance renewal notice might have given you some serious, unexpected sticker shock this year. If you've ever opened up that dreaded envelope, literally felt your jaw drop, and wondered if they made a typo, well, you are definitely in the right place. Let's dig right into this. So we have to start with a universal pain point. You see a price hike, but wait a minute, your age hasn't drastically changed. You haven't switched doctors. Heck, you might not have even used your insurance much at all last year. So it really begs the question, right? Why the increase? Are they seriously just charging us more for the exact same thing? Let's anchor this frustration with a real-world scenario. Say, last year, your monthly bill was a solid $400. Then this year, you open the notice and that exact same plan is suddenly $470. That right there is the core mystery we're unraveling today. We're going to figure out exactly what's happening behind the scenes to push that number up month after month, year after year. To do that, here's our 5-part roadmap for today. First, what is a premium? Then why medical costs rise, followed by risk pools and admin costs. We'll look at premiums versus your actual payment, and finally, how to strategically choose a plan. Okay, part 1, what is a premium? Let's define the baseline cost of coverage. Before we figure out why it's getting so incredibly expensive, we absolutely have to cement the foundation. A premium is simply the fixed amount you pay just to keep your coverage active. So if your premium is $500 a month, that's $6,000 annually. It's your baseline cost before any employer contributions or government help kicks in. Basically, it's just your cover charge to stay in the club. Now, what's really important to grasp is how completely separate the premium is from all your other expenses. Your premium is your fixed monthly cost, right? But that is totally distinct from your deductible, like a $2,000 deductible you have to pay out of pocket before full coverage even begins. And it's also separate from your $30 copays or your 20% coinsurance. Health insurance has all these different layers of costs, but today we are strictly zeroing in on why that fixed monthly premium just keeps climbing. Which brings us to part 2, why medical costs rise. Let's look at the macro drivers of healthcare expenses. So here's the deal. Insurance premiums are heavily tied to the expected cost of healthcare itself. Based on recent 2026 ACA marketplace rate filings, insurers are citing 3 huge drivers. We're talking higher hospital labor and broader inflation, increased utilization of services, and incredibly expensive specialty prescription drugs. Think about it. If a standard hospital procedure jumps from $20,000 up to $22,000 just because of inflation, or if super pricey new specialty meds like GLP-1s spread like wildfire, well, the expected costs absolutely skyrocket. And surprise, surprise, those costs get passed along. And this brings us to a really fascinating concept called utilization. Imagine an insurance pool of 100,000 members. Even if the price of individual medical services stayed totally flat, like zero inflation whatsoever, if 12,000 people need expensive treatment this year compared to only 10,000 people last year, overall expected claims shoot up. The population is just using more services. Insurers literally have to factor in both the price tag of the care and how much of that care is actually being utilized. Moving right along to part 3, risk pools and admin costs. Let's look at the hidden mechanics of insurance pools. At its core, insurance is all about pooled risk. Think about it like a giant group project. Take a look at Pool A, which is filled with mostly healthy individuals, versus Pool B, which happens to have a larger share of people needing really expensive treatments. Pool B is going to cost way more to insure. It works a lot like car insurance, actually. You might be a fantastic safe driver with 0 accidents, but if you live in a zip code with soaring repair costs and tons of crashes, your rates might still go up. In health insurance, your personal lack of doctor visits isn't the only thing dictating your premium. You are financially tied to the expected costs of your entire pool. This is exactly why location matters so incredibly much. Person A in Texas and Person B in New York could essentially buy plans with nearly identical benefits, but their premiums are going to be completely different. State regulations vary, the level of competition among insurers varies, and local hospital networks charge totally different rates. So if your buddy in another state is only paying $400, you really can't assume your plan should cost the exact same. It's a completely different ballgame. Now, I know there's a really common myth out there. People think that when premiums rise, it's just pure corporate greed padding the bottom line. But actually, under the Affordable Care Act's medical loss ratio, or MLR for short, insurers in many markets are legally required to spend at least 80 to 85% of premium dollars directly on healthcare and quality improvement. If they don't hit that mark, they literally have to issue cash rebates back to consumers. So yes, there are admin costs like claims processing and customer service, for sure, but the vast majority of your premium is legally bound to cover actual medical care. All right, let's transition to part 4, premium versus actual payment. Understanding those big 2026 ACA shifts. This next distinction is absolutely crucial to wrap our heads around. There is a massive, massive difference between the raw sticker price the insurer charges, that's the premium, and the final amount you, the consumer, actually pay out of your own bank account. This distinction became a really big deal going into 2026 simply because the enhanced premium tax credits that we had through 2025 ended up expiring in the ACA marketplace. To put that into perspective, staggering data from KFF shows that because of those expiring tax credits, average ACA marketplace premium payments after tax credits are applied jumped from roughly $113 a month in 2025 to $178 in 2026. Guys, that is a whopping 58% increase for the consumer. The underlying cost of the healthcare itself didn't necessarily jump 58%, but because the government financial assistance shrank, it dramatically shifted what consumers actually felt in their wallets. Let's actually walk through the math on this to see exactly how it plays out in real life. Let's say in 2025, your base premium is $600, but you get a $250 tax credit. That leaves you paying $350. Simple enough, right? But now, in 2026, general medical costs push that base premium up to $60. And let's assume your financial assistance also shifts, maybe settling at a $260 credit. Suddenly, your personal payment jumps from $350 up to $400. So the underlying rate was raised by the insurer, and the subsidy landscape shifted underneath you. Both of these variables work together to dictate the final bill you actually pay. Which brings us home to part 5, how to choose a plan and navigate enrollment strategically. When faced with a scary premium hike, so many of us fall straight into what I call the Plan A versus Plan B trap. Plan B looks incredibly appealing, doesn't it? The premium is only $350 compared to $500 for Plan A. You are saving $150 a month. That's $1,800 a year. But you gotta look closer at that deductible. If a major medical emergency hits, Plan B forces you to pay $5,000 straight out of pocket before your full coverage even kicks in. Choosing the absolute lowest premium on the menu can financially devastate you if you end up actually needing significant medical care. And that is exactly why you need a non-negotiable shopping checklist during your next open enrollment. You need to leverage the comparison tools provided by CMS to look at not just that monthly premium, but the deductible, the copays, your true out-of-pocket maximum, your provider network, and any financial assistance available to you. The monthly price tag is absolutely not the only thing that matters here. You just cannot blindly hunt for the lowest premium without looking at the entire board. Yes, the government does actually review significant rate increases to make sure they are justified by rising medical costs. But ultimately, at the end of the day, your personal mantra should be this: find the plan that gives me the best overall value for my expected healthcare needs, period. You are trying to build the best financial shield for your own specific, unique situation. Which leaves us with one final, incredibly powerful question you should be asking during every single open enrollment. What will this plan actually cost me over an entire year? Don't just look at the monthly premium. You've got to look at the total financial picture before you actually need that medical care. Thanks for joining this explainer, so I'll leave you with this. As you stare down your next health insurance renewal, are you really looking at the whole price tag?